Rob, what's that in your cup?
It's a tea bag. I'm trying to read the economic tea leaves.
Huh. Let's let that steep.
I'm Archie Hoxton.
And I'm Rob Hoxton.
And this is Last Paycheck, weekly wisdom to help you retire and stay that way.
Welcome back to the Last Paycheck podcast. We're your hosts, Archie Hoxton and Rob Hoxton. And today we've got an interesting topic, and it really stems from a call that I had recently, a conversation where I was asked if I'm able to kind of read the economic tea leaves, and someone asked me to do that for them. Rob, how would you respond to that?
Well, initially I would respond by drinking my tea with my pinky out, which I'm going to do for the entire episode. But that's a really common question, and they may not ask it the same way, but they really want to know what's going on with the economy, what's going to happen. And the question this year has been, for the last couple of years, is, are we headed for a recession? And the answer is that we're always headed for a recession, right? I mean, the economy is a cyclical beast.
Right.
You have periods of expansion, periods of recession. And yeah, so we are headed for a recession at some point. But if you look at all of the smartest minds on Wall Street, they've all had to change their minds quite a bit in the last 12 months. Initially, all of the major firms were saying, yeah, we've probably got a recession in the next 12 months. Well, 12 months have come and gone.
Right.
Now what seems to be the language of the day is, well, if we do, it's a soft landing. And now I'm starting to see some of the large firms say, the likelihood of a recession in the next 12 to 18 months is very low.
Right.
I don't know if it's predictable. And you hear sayings about, if you get 11 economists in a room, you'll get 16 opinions.
Yeah.
Right.
Or the experts have predicted 9 of the last 5 recessions.
Yeah. Even better.
And it's true, because there's always going to be someone who, who can boost their platform saying something really scary or enticing. We are headed for a recession. It's going to come, sometime in the next 12 months or what have you. And they're not. Sometimes they're right, but it's hard to tell whether that's just luck or if they actually knew something or saw something in the tea leaves. And I would say they're mostly lucky, and maybe they have
mostly lucky or unlucky, whichever the case may be.
Right.
We're in our 4th decade of helping people plan for retirement, retire, and stay that way. And the longer we do this, the less confident we are in our ability, or anyone else's for that matter, to predict the near-term future.
Right. I always tell people when they ask me that question to say, hey, what's going to happen in the markets in the next few months? And I'd say, well, you might as well ask me who's going to win the Super Bowl. And because there's so many possible factors going into, what happens. I mean, can anyone really say honestly that they saw last year, the events of last year, between political turmoil, geographic, geopolitical turmoil, Ukraine war, inflation, runaway inflation? Can anyone honestly say, truly honestly, that they saw all that coming and acted perfectly? I would say no.
All right, so if we assume that no one can accurately predict the future, whether it be the economy or the markets or the price of gas
or the Super Bowl,
or what's for dinner tonight, then where does that leave us? What can we do as investors, as economic beings, to make sure that we're able to achieve our financial goals?
Yeah. Well, there's a lot of things that you can do, and I would say it comes down to having a good plan, right? Building a plan that accounts for bad scenarios to happen, right? You don't want to build a plan that only works in the good times, because, like you said, Rob, the economy is cyclical. We're going to have a growing economy. There's going to be times where it's contracting. We're going to have good markets. We're going to have bad bear markets. you want to have a plan in place that is really battle tested. It's ready for both scenarios. And then you want to be disciplined about it and stick with it. You don't want to, because one of the most common pitfalls that we see is people timing the market.
Right.
They attempt to read the tea leaves and they try to either tilt their portfolio more conservative or more aggressive, or maybe they jump out of the market altogether and jump back in to try to time what's going to happen. And if you're wrong, it can be devastating to your long-term results.
Buy high, sell low, repeat until broke. And I mean, that's human nature. So we're hardwired to make bad financial decisions, particularly when it comes to investing. And it goes all the way back to when we were, running around with a spear on the Serengeti, and we're, hunting for shrews or something to have for dinner. And suddenly the saber-toothed tiger shows up on the horizon, right?
Right.
Well, what do? I mean, we are hardwired to flee.
Right.
To run from danger.
Right.
It's great for surviving for another day, but it's not so good for investing, right? I mean, usually the worst time to sell investments is after the danger becomes apparent, right? After the market has dropped. And so the old saying of buy high, sell low, and repeat until broke, that accurately describes our normal tendency, our normal state of thinking.
Right.
Very few people have the discipline to do it the other way.
Yeah. And some people find that that tendency becomes more pronounced as they get older and approach retirement, right? Because one, oftentimes you're accumulating and you've got more to lose, right? And it hurts a lot more. And then you've also got this transition happening in life where you're letting go of your income from work and you're transitioning to living on your savings. And seeing that, those savings change, it makes you want to try to do something, anything to anticipate and protect it, when really what you ought to do is be patient and be disciplined and have a good plan and keep a long-term view.
So, we like to talk about, Archie, the levers that we have, because maintaining a sense of control financially and in a lot of other areas of our lives is really central to being happy.
Right.
And so we like to talk about the levers that we have to control our financial future. And one of them is how we address risk. And we can address it through the asset allocation strategy. What types of assets do we have and in what percentages? Things like diversification, so we don't have all of our eggs in one basket. But there are the most powerful one is to always be in a position where you can afford to ride out the temporary storm, right? And we know that bad markets and bad economies are temporary. And usually good markets and good economies last for much longer stretches of time than the bad ones do, right? So what gives us the ability to afford to be able to ride out the storm? And that is a substantial emergency fund, a guaranteed cash, whether it be FDIC insured deposits or CDs or treasuries, something we can go to when we don't really want to sell at the bad time, right?
Right. And that will also help alleviate the tendency to want to try to read the tea leaves, to want to take action that may actually be more destructive and counterproductive than positive for your financial situation. Rob, another thing that we'll sometimes hear when people start trying to read the tea leaves is they start asking about commodities. And that can include precious metals like gold. It can be copper, soybeans, corn, oil. People start talking about that and wanting to anticipate a recession by, putting their portfolio into commodities or one single commodity.
Right, especially gold.
Yeah, gold's a big one. I mean, I even see it in my own life. I'll start getting phone calls. We start seeing ads on TV all over the internet about, give us a call and we'll convert your whole IRA into gold.
Yeah.
Or they're selling gold bullion or Krugerrands or gold ETFs.
And at the extremes, there's a part of the population that is really bought into the potential for economic Armageddon, in which case all you would want to own is gold, according to them. And I don't know, have you ever tried to redeem a gold coin and buy anything with a gold coin? I mean, it's pretty hard. You got to go to a pretty shady place, and you might even need to carry some kind of protection. Anyway, we're going down the rabbit hole on that.
But that might be more important if the world comes down. Food, fuel, and some kind of, way to protect yourself than gold would be.
Maybe not the greatest investment strategy.
Yeah. I think we've heard compelling arguments about tilting your portfolio lightly into commodities, but it's more of a way to diversify than to anticipate a recession.
And probably shouldn't be a timing strategy.
Yeah,
right?
definitely.
Because the timing of it is just impossible to get right. And the one thing that I know more and more every year is that timing is pointless.
Right.
Yeah, it relies on luck. And luck is not a great way to plan your retirement. Otherwise, we would all just play the lottery.
Yeah.
Yeah.
When you've got to execute the timing perfectly if you want to do better than someone who didn't time at all and just had patience and discipline.
In keeping with the timing thing, in 2008-9, when the Great Recession happened, there were a lot of people that got out of the market.
Mm-hmm.
And getting out of the market is easier than getting back in.
Oh, yeah.
Yeah. If you're sitting on the sidelines trying to decide when to pull that trigger, that's a very, very lonely place to be.
Yeah. Well, because, for ordinary people whose access to information, if you're not a giant institution, a financial institution, your access to information it's not the same. And oftentimes it comes through news media. And by the time the picture starts to get rosy and people start talking about buying in, it's too late. You've missed the opportunity to get back in. And so that's where sitting on the sideline is another pitfall that can really hurt you. Or sitting on the sideline and saying, I know it's coming. Meanwhile, you're missing the bull market. You're missing returns. You see that sometimes, and that's another way to...
Yeah, so really, at the end of the day, it's not very exciting. It seems trite even, but you build a well-conceived portfolio, an evergreen sort of all-weather sort of portfolio, and you stick with the strategy. You rebalance periodically, so if you're able to sell outperforming assets and buy underperforming assets, rebalance back to your normal risk tolerance, you're effectively selling high and buying low when you do that. Do some of these things that don't require your luck, and you'll be much better off as a result of it.
Yeah. Now it places a larger demand on your patience and your discipline, but there's a great old saying that the financial markets are a tool that transfers wealth from the impatient to the patient. So if this is something that, if you're like most people, that's really hard, right? And one thing you can do is, limit your consumption of tea leaf readers, right, that are out there.
The talking heads on cable television.
Exactly. And they're all over the internet. I mean, they're everywhere. Limit your consumption. Have principles of discipline and patience that you live by.
It's interesting that you say that, Archie, because there's actually a ton of research that shows that people who check their portfolio values every day underperform by a substantial margin people who don't.
Right.
And that's human nature. The more you look at it, the more you're inclined to fiddle with it.
Right.
And to be moved by emotion. And the emotion is what really can blow your financial plan up.
Right. And it doesn't take very many big mistakes to completely change the trajectory of your financial plan. It may only take one. So there's, with patience and discipline, if that's something that's hard, I mean, like we've said before, a big part of what we do is we provide that to people, financial advisors.
Right. Coaching.
Provide some coaching and help to make sure that you don't make those really big mistakes that cost a lot of money.
So if we sum this up, because we're going to run out of time here in a second, Archie, reading the economic tea leaves, just don't try.
Yeah.
I mean, it's interesting. It's great parlor talk. Enjoy it, but have a strategy that you can love in good times and bad, right?
Right. Exactly. I couldn't have said it better myself. Well, that's all for today. So please leave a question in the comments. Like we say, we want to hear from you all. We might find a new episode topic from a question. If you have it, others do too. And then subscribe, share it with family and friends, and we'll see you next time.
You've been watching Last Paycheck, weekly wisdom to help you retire and stay that way. If you like this show, be sure to hit like and subscribe. Last Paycheck is available anywhere you get your podcasts.